just in terms of what Michael Saylor is doing right now, do you believe that there is an environment in the context of Bitcoin DeFi that allows for him to do exactly what he's doing on chain?
Yeah, absolutely. And the beauty about the way that Core is structured is that it allows for participants to enter in this ecosystem and participate in the Core ecosystem and the Bitcoin ecosystem at different points of sort of the risk journey. You have completely non-custodial forms of staking your Bitcoin and participating in Core consensus to earn yield. You can also move on chain, and you have through some of our partners like Solve and others, you can post your Bitcoin and get a staked Bitcoin token, similar to Steve with Lido, that you can deploy on chain and start to do different types of things, lend, borrow, and participate into again a very mature and well-established DeFi ecosystem.
Blockmates Orange is sponsored by Core Network, the ultimate Bitcoin-powered EVM-compatible blockchain. Learn more about Core at blockmates.com.
Welcome back, everyone, to another episode of Blockmates Orange. Guest today is Hong Sun from Core. His job description is a lot of things, but at the center of it, it's all about bringing institutions and bringing education around the product that is CoreDAO. We talk about real world assets. We talk about, what the future looks like, in the space, in DeFi, but more importantly around Bitcoin. And I think Hong's got a lot to say about it. We've just been catching up before this discussion, and I think you guys are going to be in for a treat. This is no longer playing games. Things are starting to get serious. But before we get into the serious stuff, introduction, please, sir. Tell us a bit about yourself and why you're at Core and what your mission is.
Yeah, thanks, Jedi. Thanks for having me on board. Super privileged to be here. Recently joined Core as you mentioned, head of institutions. I spent 4 years at Paxos, New York DFS regulated trust company. That was my first sort of professional entry into the crypto space. We supported a lot of the home, household names and TradFi to get into crypto in a native way, but in a really trusted way because of the regulatory nature of a lot of these institutions. And spent the last 2 years at Paxos focused on stablecoins. And so one of the reasons why I joined Core is because the themes that was continuing to come up at the time was around, capital efficiency around assets either at rest or being held as collateral, right? And we really kind of solved that aspect of, how do you earn yield for dollars with tokenized money market funds, with BUIDL and Ondo, Hashnote, and a number of others, including Paxos' own USDL product. ETH has really solved that with Lido and Steth, and you can post an on-chain version of the ETH and earn yield. Bitcoin was the large genesis and hero asset that's yet to receive some of those benefits. And it's really exciting today with participants like Core and other protocols really addressing that and solving that head on. And so, we're looking at, how do institutions participate in the BTC DeFi space or BTC-Fi space in a safe, sustainable and scalable way. And so my job at Core is, leading our institutional efforts is really around educating the market, really helping participants, whether it's individuals or institutions, fiduciaries, et cetera, understand, what are the sort of primitives and risk assumptions around BTC and earning yield, and especially around Core, enabling institutions access to earning yield in a safe, scalable, sustainable way. And then because Core is, we'll get into more of this, but because we designed Core in a way that it's accretive to both the BTC and Core ecosystem, ultimately the institutions that we talk to and that are participating become evangelists of Core. And so it's a really exciting journey that we're all embarking. Me personally at Core, but also I think as BTC holders, miners, and all participants in crypto to have a way of scaling Bitcoin and participating in additional efficiencies with yield, et cetera.
Okay, great intro, and obviously a lot to consider in terms of what is obviously currently playing out in the Bitcoin DeFi space. I mean, let's start at the beginning of, like, what is the starting point for institutions, and like when they look at this whole thing, what are the criteria that they actually look for? I mean, obviously security, I would assume, is one of those things, but just kind of give us a map and kind of like an eagle's eye view of what it is that their expectation is, from a security perspective, and then obviously from a functional yield earning perspective. Today's podcast is sponsored by Glyph. Glyph is a non-custodial decentralized exchange operating on the Core network. As you know, we've spent a lot of time focusing on Bitcoin DeFi on this podcast, and essentially what Glyph is doing is replicating what Uniswap has done on Ethereum. So they are obviously dedicated in developing a sustainable and innovative DEX on top of Bitcoin, much like Uniswap, and just taking this whole Bitcoin narrative to the next level. So they've got a unique non-custodial approach which allows users to retain ownership of their Bitcoin while enjoying the benefits of a decentralized exchange experience. Their website is glyph.exchange, and you can go and trade a variety of assets there like BTC, USDT, USDC, and a lot more. Go check them out.
Yeah, and when we talk about institutions, this term gets thrown around very broadly. So in general, when we think about institutions, refer to institutions, it's really participants of size, right? This is when you start to get into a space where risk really matters, whether it's risk for large holders of Bitcoin, when you start to come into meaningful capital and risk become magnified at scale, or where you're a fiduciary and you're managing someone else's principal and you want to make sure that you're abiding by all applicable regulatory compliance rules and operating in a safe space. So the number one question that we're trying to solve for institutions, and personally I've gone through the same exercise in evaluating Core and others in the space, it comes down to risk, and principal risk is really important, right? Any holder of Bitcoin, the number one thing you care about is not losing your Bitcoin. And so when you think about security, it's when you're participating in earning some sort of reward or return in Bitcoin, are you putting your capital at risk? Are you putting that principal Bitcoin at risk? And today there are a number of ways that institutions can participate in some sort of yield and active strategies. They can lend out their Bitcoin, but they're always going to take some sort of counterparty risk or some sort of credit risk. The way that Core has been designed as a protocol that's Bitcoin aligned is really to kind of mitigate those type of risks. We'll talk more about the security of Core, and Rich was on your podcast a couple months ago, did a great job of explaining the consensus mechanism behind Core. But where it matters for institutions is if the simple equation of I'm staking my Bitcoin to expect some sort of yield is around like what happens to that Bitcoin, right? What am I putting at risk? When you stake Bitcoin with Core, you're actually participating in the security consensus of Core. You're securing Core network, and it's important to know that, principally speaking, you're never needing to transfer your Bitcoin. You don't have to move it out of your non-custodial or custodial wallets, and you're not taking any slashing risk, which is really important. Which means that when you stake your Bitcoin, you continue to hold your Bitcoin wherever it lies. And the mechanism that Core achieves it is, again, through its consensus, novel Satoshi consensus mechanism. The staking protocol, right? When you actually stake your Bitcoin to earn Core rewards, you can think about it in two parts. The first part is what you're doing with your Bitcoin. On Core, when Bitcoiners stake Core, they're writing a transaction to the Bitcoin network, to the Bitcoin blockchain, and it's using something called CLTV, or time lock, or check lock time value, which is native to Bitcoin. It's been around for 15 years, or been around for over a decade. I think it was launched in 2015, and it's actually invoking some form of smart contract capability. Bitcoin, you can anyone with Bitcoin can lock their Bitcoin, any amount of Bitcoin. This, where they're actually contributing to core is satisfying a specific set of criteria that that core is looking for, that meets its needs to earn rewards, and that is a certain amount of Bitcoin time locked for a certain period of time, and where you're actually then adding a little bit of metadata onto the Bitcoin blockchain that's essentially voting on the core validator set, and thereby securing core. When you do those two things, that's when you're earning a portion of the core block rewards or emissions. That is where effectively the yield comes from. So for institutions, right, you think about that, it's really about like, okay, so how does it work? You take my Bitcoin, right, and I'm invoking some transaction on the Bitcoin blockchain. There's nothing to do with core, right? You time lock it to yourself, at which point it expires and you redeem it. Anybody can do that today. On the core side, there is a piece of the core blockchain, it's called the relayer, that is validating and verifying the messaging that gets written to the Bitcoin blockchain, looking for any part that's actually valid, part for the core consensus. And once it's been verified, then core distributes rewards back to the Bitcoin holder and the core wallet that's specified in that transaction piece. So there's also been, therefore, in addition to no principal risk, you're not taking any sort of protocol risks with core. And that's really important for institutions as well, is that even if, for example, core chain goes down for a certain period of time, your Bitcoin is safe, right? And so it all comes back to this sort of concept of, if I'm staking my Bitcoin, right, with core, is there a permissionless way of earning rewards by participating in, the security consensus of the core network? And now the answer is yes. And that's really novel. And the other part of that is there's also no slashing risk to Bitcoin holders, right? And this is really critical. And when the ETH ETP and ETH ETFs were considered, this was actually one of the critical components that regulators, had an issue with, which is, if you're staking ETH to earn ETH block rewards, right, there is slashing risk. With core, again, because of the way the consensus is structured, where you have the Bitcoin community, miners and holders actually contributing, large majority of security to core, there's really no need for slashing the delegators. And that is a design, attribute of how core was structured. And so if you remove principal risk and slashing risk away from, the ability to earn yield through core, that removes a large chunk of risk from institutions that are looking for ways to participate in yield in a permissionless way.
I mean, the only question that I have around this is like, what are the risks in essentially this dynamic between the user and the core network? Is it about the time period? So is it about that time? So if, first of all, is there like a time period that you have to lock on that period? So you're not actually locking your Bitcoin and handing it over. You're essentially not able to do anything with the Bitcoin, even though it is in your wallet. Is that correct?
Yeah, that's right. And so the risks really someone thinks about here is duration risk, right? If we really have to identify a risk component. When you time lock your Bitcoin, again, you can time lock it for any period of time, but for it to be a valid sort of within the valid parameter of contributing to core's consensus, it's a minimum of 10 days. And there's a number of reasons why. I think Rich mentioned some of that, which is to ensure that it has sufficient time to process and be validated by the core relayers. But that's really the risk that someone would take. And when you think about, for a majority of Bitcoin holders, right, they're tucking it away in cold storage. They're really not accessing their Bitcoin. And so if you can accept sort of all of the other, assumptions that we've just outlined, the time risk portion is something that's very manageable. And depending on where you are in your risk curve or what type of holder you are, what you're trying to do with your Bitcoin, that's a risk that many institutions understand already today.
Okay. So how interested are institutions at the moment? Do we have a huge amount of interest? Are people dipping their toes? Where are we at in that journey at this point?
Yeah, I would say institutions are very interested. There's well over 2 million Bitcoin held by institutional holders, whether it's corporations or ETP issue or ETF issuers, um, companies holding Bitcoin in treasury, right? That Bitcoin is sitting today with some sort of opportunity cost, whether you're paying custodians for that cost or just unrealized, economic activity that can be gained. When you start to introduce now a way for Bitcoin holders to permissionlessly earn, some form of yield by participating in security of a protocol like Core, there's a lot of interest and demand. You also had Dan Hughes from Radix on Blockmates a couple episodes ago talking about product market fit, right? And another sign where Core is a standout in this space is that there's already product market fit today with institutions. Today you have nearly 8,000 Bitcoin that's staked with Core, earning some form of return in Core tokens, and as part of that, also you have companies like Saylor that's issuing a regulated ETP in Germany and in Europe, where you have capital market participants that's able to access not just Bitcoin, some sort of spot representation of Bitcoin, but also Bitcoin that's earning yield, right? And their plan to take this around the world to different markets. But that means that effectively someone and some regulators have looked at the mechanisms behind Core and approved that mechanism as something that is approved, and is acceptable from a risk perspective, from a compliance perspective, from a technology point of view for institutions. So we're going to start to see a lot more of these use cases where you have institutions holding Bitcoin, participating in securing Core, and therefore earning rewards with their Bitcoin. That creates utility for Bitcoin immediately. And again, the amount of Bitcoin out there, right? There's $1.5 trillion of Bitcoin that's currently in circulation. There's now a real opportunity to put that Bitcoin to work. And so this is the exciting part for institutions. And I think once we get sort of past the sort of underlying understanding of what risks are involved, is this yield sustainable and also scalable to the level of institutional holdings, there's a really, really interesting unlock here that institutions know how to play very well, right? Whether it's in the crypto native Web3 space or in the capital market space. And this is a piece where I think we're just at the very, very beginning innings of starting that adoption curve and moving into what can be the sort of the next wave of Bitcoin summers, if you will.
So what does the sales pitch look like? I mean, when you sit down with an institution, it's all fine and well that you and I can obviously speak a language that is very much confined to a Web3 context. We understand the dynamics of DeFi. We understand the relationship between, validators, nodes, dexes, the rest of it. How does the conversation look like when you walk into a boardroom and you're sitting down with an asset manager or a number of asset managers or even a CEO? How do you actually relate this insane world that we live in to somebody who might not really have an absolute inkling as to what's going on here?
Yeah, it's a great question. I would say, to simplify it, it's really, you're sitting on Bitcoin, the asset, right? It's arguably the best form of currency, reserve asset. And there's now a way to earn yield against that asset, right? And you can do it in a way where you're not risking principal, right? You're not risking you're not taking on any sort of new trust assumptions here. There's no slashing risks. What you're doing to earn that yield is by participating, in securing this new blockchain primitive. And there's a lot of things that can be done here, but the way that you can actually deploy and earn that yield, you can do so already with the same trusted, qualified custodians you're holding your Bitcoin. And depending on how these companies operate and what type of yield returns they're looking for, we have now a very achievable way of getting more capital efficiency against Bitcoin, the asset. So again, I think it's a journey around educating the market around institutions who are holding these Bitcoin and looking for ways to generate yield. But we now have options here where we can start to go down this journey and education process and ultimately arrive at a point where we're enabling Bitcoin holders to participate in a very diverse ecosystem in crypto and earn a real rate of return on their Bitcoin asset.
Okay, I'm sold. If I was an institution, I would be very interested. So, I mean, it makes sense, right? It's kind of like you have an asset that can give you a return. You don't have to give it away. And there's a benefit, beyond just kind of its capital value and its growth and all that good stuff. But it can actually earn you rental per se. I mean, that's ultimately what DeFi has taught us from a lending and borrowing perspective. I mean, just in terms of what Michael Saylor is doing right now, do you believe that there is an environment in the context of Bitcoin DeFi that allows for him to do exactly what he's doing on chain, as opposed to having to go the other side of the fence, namely the institutional route, where he's obviously underwriting and doing a whole lot of really creative stuff? Do we ever arrive in the DeFi context and be able to do that kind of stuff? And does Core potentially play a role in a world like that?
Yeah, absolutely. And the beauty about the way that Core is structured is that it allows for participants to enter in this ecosystem and participate in the Core ecosystem and the Bitcoin ecosystem at different points of sort of the risk journey. You have completely non-custodial forms of staking your Bitcoin and participating in Core consensus to earn yield. You can also move on chain, and you have, through some of our partners like Solve and others, you can post your Bitcoin and get a liquid staked Bitcoin token, similar to Steve with Lido, that you can deploy on chain and start to do different types of things, lend, borrow, and participate into, again, a very mature and well established DeFi ecosystem. So depending on what you're trying to do with your Bitcoin and what your risk tolerances are, I would say there are now a number of new primitives and use cases that some of them are very well established in the Ethereum world that can be now ported over to the Bitcoin ecosystem through Core. We're about to launch an upgrade to the Core staking called dual staking or fusion upgrade, where we're also starting to introduce much more scalable means of earning yield for institutions of size. Right? What we talked about so far is around, is there a safe and sustainable way of earning yield through Core? Right? The safe way is you're not transferring your keys, you're not having to take on any slashing risk or principal risk. And the sustainable way is that, with Core emissions being over 81 years, plus Core's diverse ecosystem contributing to the yield generation and the yield payouts, it creates a way to effectively earn yield sustainably over time. But now, with this fusion upgrade, for Bitcoin holders that want to just post Bitcoin and earn yield, they can earn a base rate of return. But you also have participants that are that want to participate more deeply into the Core ecosystem. They can also post Core, and the protocol will then reward those Bitcoin stakers that also post Core, a higher share of the fixed emissions, and thereby really linking the two communities together. And through that mechanism, you can now start to build additional products on top of this dual staking, platform. Move more assets on chain through liquid stake products, etc., and participate in deeper and deeper integrations and involvement into the DeFi ecosystem. Very much similar to what you can do already today with other high performance L1, L2 protocols.
Yeah, I mean, it is like it's kind of like boring. Like Bitcoin was boring for such a long time. In terms of its ability to just not do anything. I mean, it was like kind of like, I mean, people made fun of it and said, "Yeah, it's a pet rock," and it's almost like in the last kind of like 18 months, it's obviously all been put on its head, and it's like, okay, well, Bitcoin can now actually participate in an environment that is truly decentralized from a traditional finance perspective, which is great. For me, it's always been about how do you deliver this thing? How do you actually deliver it in a way that is easy to digest, easy to understand, and most importantly, easy to use? Obviously the education part that you speak about is like, I mean, it's critical, right? I mean, that's what we do. We love what we do because we obviously are providing that information for people to actually be able to do this kind of stuff. How do you guys approach the relationship side of things within the business context side? So it's all fine and well that you've got developers and you've got projects coming in and they're developing, lending and borrowing and dexes and all this kind of stuff, but you still have to create a brochure and you still got to go and sit down with an institution and essentially sell the dream. And I wanted to just understand, where are you guys in that journey? You've obviously given us insight into, this is the sales pitch, this is the value proposition, but where do you guys sit in relation to, first of all, competitors? And how far down the journey are you where you can actually turn around and say, okay, well, we're probably 2 years away from, $10 billion, where we actually have 100 institutions, so a significant amount of money. What does that kind of like roadmap look like for you? I know it's kind of like a big question, but it's also something that I'm pretty sure you've got a really good handle on.
Yeah, Rich has said multiple times on this podcast and others that we're just 1% of the way there. And what's interesting is that 1% of what, right? Because crypto's
I was about to ask you, like, how
to grow. Exactly. And so this is where it gets really interesting with Core. And I think ultimately Core is an accretive, it has a very symbiotic relationship with the Bitcoin community. And it was designed purpose-built for that reason. You have Rich and team and some of the initial contributors at Core who are Bitcoin maxis, right? And also those that really understand the value that the Ethereum ecosystem brings. And we've been able to merge the two together to build a platform where it solves, where Core really aims to solve two of the principal sort of necessities to add utility to Bitcoin. Number one is adding scale and building, decentralized application functionality on top of Bitcoin through Core's, EVM compatible high performance L1 chain. There's a very diverse ecosystem that's building on that chain, and that's contributing to the Core ecosystem and the Bitcoin alignment there. And number two is that it's purpose built also to support miners in the long run, right? And we talked about the security budget and where through each halvening the economic incentive for miners have diminished. Even if you're a long-term Bitcoin holders and you don't want to do anything with your Bitcoin, right? That becomes a concern, because how do you continue to incentivize the mining community to continue mining Bitcoin when today there are also attractive alternatives in high performance computing and a number of other initiatives that could be potentially providing alternative revenue sources for these miners. And that's where Core really shines, right? You're creating a mechanism in which on day one that sits alongside Core. Bitcoin now has utility. The Bitcoin holders can contribute to securing Core in return for Core rewards, and Bitcoin miners can continue to mine Bitcoin as they always do, and also participate in securing Core in exchange for Core rewards. That is really novel today. And if you're a developer or you're someone that's trying to build on a high performance chain, there are a number of those to choose from today, right? Including obviously you have Ethereum and the diverse world of L2s. You have other L1 high performance chains, but no other chain is aligned as closely to the Bitcoin community as Core. And so as you're building, these products and platforms, there's now a really interesting decision that starts to come up, right? It's like, if what I'm building on grows and successfully continues to scale 10x, 100x of what it is today, how does that impact Bitcoin? Does it add to the Bitcoin narrative? Does it help the Bitcoin community grow in return? Or is it taking away from Bitcoin as a reserve asset and, all the things that and attributes that, Bitcoin community holders and every crypto participant should really care about? So I think principally speaking, this is where Core becomes really interesting. When you then peel away all the economic incentives and sort of the risks, like that's where principal alignment is really critical. So the way that Rich and the entire initial contributor set of the Core community is designed Core is to build that symbiotic relationship. Day one, Bitcoin now has utility in securing Core, and as the Core community grows, right, the gas fees and transaction fees, in addition to the fixed emissions, will pay to subsidize the revenues for Bitcoin miners and Bitcoin holders to continue to keep Bitcoin decentralized and secure. On top of that, right, this is also where institutions start to get interested, because there is now a way to participate in earning yield or some sort of return on top of Bitcoin in a totally safe way, right? In a risk-free way where really you just manage duration risk, but now you're able to actually earn some sort of capital return by securing Core. And the sustainable aspect of that, going back to that point around the community, we're just getting started here, right? If you look at Core's TVL on DeFi Llama, I think it's somewhere around 600 million. It's a top 15 chain. The beauty of that is, Core's grown organically. Since its fair launch in 2023, it's really community involvement, developer involvement that's helped to drive adoption on Core. And we think the next wave of adoption will continue to come from the community, but also with this alignment around Bitcoin, there's a real opportunity here, and we'll hopefully be able to share more on this topic soon, where you can think about a world where every developer and dApp and ecosystem and use case that gets built on Core will continue to feed to incentivize both Bitcoin miners and Bitcoin holders, in addition to Core participants. And that's a really novel value proposition we don't see anywhere today. And so, I think we're just getting started, but that 1% could still be 1%, even if we're wildly successful in a year or two from now, because of how much the blockchain ecosystem has also grown along with Core.
Yeah, I mean, what I really like about kind of like your delivery around this question is that there's a very clear symbiotic relationship between many facets. Like it is like your ultimate Lego block collection. It's like you've got the miners who secure the network, you've got the core validators which also secure the network with the miners, then you've got community driving interest, and then obviously the institutional side of thing is critical to the revenue and the TVL and all that kind of stuff. Even though, I mean, we could argue that TVL is a meme. At the end of the day, if there is capital, doesn't matter whether it's a meme or not. It's pertinent to what it is that you guys are doing, and for any blockchain for that matter. It's the grease that basically drives the wheels. In terms of just coming back to the competition, because obviously from a blockmate's perspective, like, we like to understand why people are doing what it is that they're doing, even if they're not doing a particularly good job of it. But that's not what this is about. I'm just more interested around, like, is it really, like, do you guys feel that it's like you're looking behind your back and saying, okay, well, we're ahead? Is it a case of, well, we don't really care what anybody else is doing, we're on our own mission? Is there like that dynamic that's going on at the moment? Just tell us a bit about how you guys view competition and the dynamics that exist between, other side chains in relation to what you guys are doing.
Yeah, definitely. And I'll kind of take this view. I think, in crypto, because we're all trying to grow a community, and we ultimately believe that you have, the potential for trillions of dollars, hundreds of trillions of dollars to flow from TradFi into blockchain. It's really a case of rising tide lifts all boats. And for Core, and one of the reasons I joined Core is that they're very much principle and mission focused on, creating long-term viable communities around Bitcoin and bringing applications that create not just, that support existing use cases on other L1 chains, but also introducing new primitives, new use cases that's only now possible because you're also aligning with, the largest crypto community on chain. And so, as we kind of look forward, there are, you said it yourself, I think, looking at, based on the conversations with Rich in the past, there's so many things that we have on the roadmap to build. And so, we're only really focused on how do we deliver value for the core ecosystem, for the Bitcoin ecosystem. And also, for me personally, because I'm focused on institutions, how do we bring along, this wave of new institutional adoption into the space in a way that works for institutions? It has to be safe, it has to be secure, has to be scalable, and has to be sustainable, right? And in making sure that we align around those principles, that's how we grow this sort of roadmap and adoption phase. And I think what we're going to start to see in a couple months from now, once dual staking launches, you're going to have market dynamics, really interesting market dynamics start to play out. You'll have some folks who will want to just stake their Bitcoin, and that's totally fine. But there are also going to be others that want to be more deeply tied to the core community, who will also stake their core to secure the core network, and they're going to get a larger share of the core emissions pool, right? And this is the part where really it's kind of choose your own adventure. And so on just the Bitcoin staking side, we're going to see a tidal shift in new ways that people are going to start to think about Bitcoin as the asset, as the reserve asset, and what can they do with it. From, on the one hand, just doing the bare minimum to participate in an ecosystem that they know is going to help support Bitcoin security long term, or going deeper and deeper into the BTC-Fi space, where they can partake in really, really interesting novel ways of involving Bitcoin into the DeFi community. And on the other side, on the core chain, like I said, there's going to be a ton of new enhancements coming out. We have an entire playbook that we can borrow from the existing, L1, L2, and the, sort of EVM compatible world of what type of primitives can be built. But we're also going to create really interesting incentive alignments so that those that are building on core will also have a way to contribute to Bitcoin security ultimately. So I think, the world is really exciting. What we hope will happen and what we're building towards a future is where, there will be something for everybody, right? Depending on what your risk tolerances are, what type of returns you're looking for, so long as you can participate in a safe way, and safe, in whatever world you operate in. For institutions, that's, safety of principal and asset. There's regulatory concerns, there's compliance concerns, there's sort of additional fiduciary concerns. But whatever journey you happen to be on, I think there's a way, and there's a path to participate with core, where we're unlocking real world value, and making the blockchain space, the Web3 space, just even more acceptable and more exciting for capital markets participants, TradFi participants, and also the sort of crypto native crowd.
So, I mean, I want to get into the regulatory side of things, because obviously we've had quite a lot of opposition, seemingly so. I mean, I stand to be corrected, so if anyone can correct me, by all means do, after the show, whenever. But it seems like there has been opposition, in kind of like from a regulatory perspective and SEC, and we've seen kind of like, actions speak louder than words. How do you guys navigate essentially that environment right now. You know, if you are speaking to Wall Street and you are kind of like bringing in, you know, institutions that clearly are interested, what are the criteria that have been presented to you as a company, as an organization around these kind of things? Are there gray areas still? Is it very clear as to, you know, what that roadmap looks like? Yeah, fill us in on the day to day and how you guys are actually addressing those challenges.
Yeah, so first of all, I'll just say, you know, I'm not a lawyer, so nothing I say here is considered legal advice. But you know, in terms of how we work with institutions, and I've worked with, you know, institutions for over 4 years while I was at Paxos, it's really letting the institutions lead, right? They're our lead dance partner, and they know their regulatory set, and they're in constant conversations with their prudential regulators, others in the space, policymakers, and so what has really kind of come back as feedback for us that supports the core narrative, you know, and I think anyone kind of building in the space should think about is just making sure that there's principal asset protection. So coming back to core, and you know, another reason that I really kind of give a lot of credit to the initial founders of core, initial contributors, is that you have core, which is, you know, first of all, was fair launch, right? And so there's no external capital that has additional incentives to liquidate core, provide additional selling pressure on core. It was built by the community, right? And the entire value proposition and the principles that core is built on is to provide utility to Bitcoin, right? It's to provide long-term utility to Bitcoin holders through rewards in exchange for securing core, long-term incentives for Bitcoin miners, right, for securing core in exchange for core rewards. And so it all speaks to the sort of the ethos of blockchain technology itself, which is the decentralization narrative and the security long-term. But also, I think when you look at, you know, what regulators care about, and certainly, you know, if you kind of take the point of view of any regulated institution, when they're evaluating a new project or new protocol, it's really, you know, beyond the sort of the KYC compliance risks, which is up for each institution to manage and to sort of mitigate risks there. When you look at, you know, the number one risk that institutions, you know, have questions around is, hey, what am I risking to get something in return? Right? Am I risking my principal asset? In this case, am I risking Bitcoin to earn yield? Am I doing something, you know, am I introducing some sort of new risk assumption here or new trust assumption by participating in this new ecosystem? And again, we time and time again come back to this point that no, right? You're not risking your principal. There's no slashing risk. You're not trusting core to hold your Bitcoin, to manage your Bitcoin. You continue to, you know, keep your, you know, custody your Bitcoin with qualified custodians, right, who are responsible for maintaining the safe, security, and sort of bankruptcy remoteness protection that regulators really care about. All you're doing is it's sort of writing a transaction to the Bitcoin blockchain. And if you trust Bitcoin, you can trust staking your Bitcoin with core. On the other end of it, right, it's up to core to pick up that message and then distribute the blockchain rewards to those that have voted on the validator set. So you've kind of now separated the risk assumptions and the trust assumptions around Bitcoin, the asset, and the activities that happen on chain permissionlessly with core in order to provide the rewards. And so I think as long as we kind of operate within those lines of, you know, meeting institutions where they are and meeting the regulators where they are, where they have raised concerns in the past around principal asset risk or, you know, taxable risks and things of that nature, we'll continue to support building the ecosystem around core and building, you know, supporting developers and those that are helping to grow both core and Bitcoin communities.
When would a custodian step in in the equation that's currently playing out on the product offerings that you guys have? Because is it about sort of like the liquid staking side of it? Would there be a demand for a third-party custodian, whether it's a Coinbase, Fireblocks, or whatever the case is? Just explain that dynamic to us, because obviously institutions are going to be like, well, I need somebody that is kind of like tangibly there. They might not kind of like buy this whole permissionless thing, trustless thing. I mean, is that playing out at the moment? Is there a demand for custodians? What's that dynamic looking like?
Yeah, it's a great question, and the answer is absolutely yes, right? We've talked about this concept of non-custodial staking with Core. There's maybe something to clarify there, which is the non-custodial term is really a technical term, meaning that you're not relying on a third-party custodian to stake your Bitcoin, right? Anyone can really stake their Bitcoin and continue to hold the private keys. With institutions, of course, right, many of these institutions have to custody assets with a third-party custodian, be it a qualified custodian like a BitGo or an Anchorage or Coinbase or Copper. That's just a requirement for any institution that's participating in this space. And so Core also meets that requirement wholeheartedly. Right. So we already have Copper as a qualified custodian supporting staking both Bitcoin and Core. And where clients like, I mentioned Valor earlier, that's issued a yield bearing ETP with Core, they can hold their Bitcoin asset or their Core with the QC, Copper in this case. And Copper will then be responsible for directing the messaging to stake client assets with Core. So what's really interesting is in this case, right, if you are an institution and you have assets that's sitting at a custodian, you can keep those assets at the custodian and continue to participate in this sort of security consensus of Core and earn Core rewards, right? And so that is also really critical for many of the institutions that we talk to, because while we love the idea of holding your own Bitcoin safe and not your keys, not your coin, that's just not a reality within the institutional world. So institutional custodians are a critical part of the enablement process, I mentioned earlier, of how do we onboard these institutions to participate in the Core ecosystem. Copper is one of the custodians that's already supporting staking Bitcoin and Core today, and they went live in August. But we have a number of the top institutions coming online this quarter. And so what we think will happen, right, is we're going to start to see, again, more and more types of use cases around Bitcoin start to emerge over the next quarter or two. The very base vanilla flavor, if you will, is staking your Bitcoin through your existing custodian to earn Core rewards, right? The next level up with the Fusion upgrade coming out is a deeper, involvement and tie into the Core ecosystem. Perhaps you may want to earn a higher, reward rate than just the base rate, right? You can then, through your custodian, stake Core alongside Bitcoin to earn a larger portion of the fixed emissions, or effectively a higher yield. And then beyond that, you have an entire world that exists within sort of the TradFi Web3 world, where Bitcoin can be used as a form of collateral. It could unlock different opportunities within exchanges where Bitcoin is held off exchange to, again, open up different trading strategies, active or passive, around Bitcoin through Core. You mentioned the liquid stake Bitcoin. That's also something that is also possible, right? Custodians can custody a liquid stake Bitcoin token, right? You have a number of those. Solve is one that supports Core today. We'll see a number of these different permutations of liquid stake Bitcoin. There's different trust assumptions that you have to assume there. But now, through the custodian, you can hold those assets off exchange, trade on exchange, right? Trade margin on exchange, and that further unlocks capital efficiency. And that's a reality that kind of goes back to the point earlier of why I joined Core, was really kind of pursuing this this narrative where we think all assets at rest and held as collateral should be earning some form of yield. And now finally with, Core and being able to earn yield on your Bitcoin through Core, we can start to achieve and sort of satisfy some of those capital market demands around yield on collateral. So I think it's a really exciting time for us, and I'm really excited to see what types of use cases are going to arise from not just what we're building, but I think the entire growth of the BTC-Fi ecosystem is starting to launch over the next 1, 2, and 3 quarters. So we'll have more to talk about, but I think this is just the beginning to a very exciting journey ahead.
Yeah, I mean, based on the answer you've just given, Michael Saylor could definitely raise another $42 billion on a network, provided it has liquidity. That's what it's actually all about, right? The success of protocols like Aave, and I think Colend is essentially doing the same thing on the core network. It's been done before. We've seen it. Ethereum has laid a great foundation for, these kind of products. And I mean, the whole liquid staking thing is, obviously it was going to land up happening on Bitcoin, and it is. And you guys are obviously a big part of that process. Coming back to a tide rises all ships, or all ships rise with the incoming tide. Do you think that there is a place for multiple side chains right now, like for the medium to long term, or do you think there will be essentially kind of like the ones who have the community, have the momentum, and more importantly, that capital flowing through them to kind of like absorb the others? Or do you think it's going to be kind of like this Alt2 scenario that we're seeing in Ethereum, where there are so many of them, and in many ways they are restricted, but they still exist and they still seem to be functioning okay? Or do you think we're going to land up with maybe 2 or 3 side chains and then eventually just 1 or 2?
Yeah, look, I think in the near term, right, the beauty about crypto is that it's decentralized. So we effectively are building a petri dish for innovation. And I think there will be a lot of these side chains, and whether it's Bitcoin aligned or not. And I hope there is, because it sort of creates different ways that we can test and prod and innovate around the ecosystem. And there will be, different types of reward incentives, whether it's, points. Some might be, some might see points as acceptable forms of rewards. And there will be others that are looking for real rates of return on something that is liquid and trading. But I think when you start to look into what institutions care about, right, the whole meme of institutions are coming, it's really that you have institutions with size that are coming. And I think when you start to get into the areas of scale, when we move beyond just thousands of Bitcoin staked or tens of thousands of Bitcoin staked, which still represents, a fraction of a percent of the overall, Bitcoin market cap, that's where you're going to start to see leaders really emerge, because it's very easy to create mechanisms to incentivize participants at a very small volume, and we've seen that playbook play out.
It's called Ponzonomics.
Yeah, right. You have marketing incentives. You have all sorts of things that convince people to pledge some amount of their Bitcoin, to dabble here, dabble there. But really, when you look at institutional size, it means that you have to satisfy all of sort of the risk assumptions that institutions need and care and are required to pay attention to. And only then, when they get comfortable around that, will they actually bring on size. So the ones that will emerge as winners are the ones that have gone through the proper due diligence process, vetted by institutions, that have real world applications at scale, whether it's ETPs or other sort of capital markets product that are live in the world, that have been vetted and reviewed and approved by regulators. And only then can we start to really kind of bring on the size and scale that we can finally coin as institutional adoption. So it's a playbook that I've I know well and have experienced through Paxos and seen play out across different primitives and use cases on chain. And so I think we're starting to see some of that take hold, and it'll be really telling in the next call it quarter to a year or two on how this ecosystem develops and evolves. But I think where we're sitting at the core, we're very excited about supporting the clients that have the institutions that have participated on day one, as well as enabling more and more institutions. First of all, educating the market on what is possible and what are sort of the risks involved and what needs to kind of be looked at prior to participating, and then really enabling the market to participate, right? Enabling the custodians to come online and support this primitive and participate in sort of the technology and utility that Core affords, as well as building new use cases that are unique to every one of these custodians or exchanges to allow institutions to do what they do, right? They, when you give someone at Core told me that the children's book, right? When you give a mouse a cookie, right? It's like institutions know how to play at scale, and when we start to create a safe space to operate in, that's when it gets really exciting, and when we can actually deliver scale that is secure and sustainable both at the same time.
A big part of this whole environment and what kind of like is critical to everything is obviously stable coins. We know that it's possibly going to be the biggest thing in blockchain technology in the future. I mean, already is massive. I understand that you guys are busy. I mean, you've obviously had previous experience with Paxos. I mean, they're no slouch in the business either. How is that kind of experience that you've obviously had on that side of things being brought to Core? Is there an interest from Core's perspective to have a resident stable coin? What does that dynamic look like? I know that I actually haven't even really covered this topic with Rich much or anyone else within the Core ecosystem. It's obviously probably the single most important thing besides Bitcoin in this space. Surprised I haven't discussed it, but I've got you here now, so there's your opportunity.
Yeah, listen, for any chain, right, having a stablecoin on the protocol is a massive unlock from a utility standpoint. Stablecoin is arguably one of the best product market fit use cases for blockchain. It's near instant, low fees, borderless, and can be settled almost immediately. And when I've had extensive conversations with Rich. Another reason why I think Core is so well positioned in this space is because it is an L1. It's a protocol that through governance, vote, etc., can really take shape and build a platform for issuers of any kind, stable coins or RWAs, to participate and actually do so in a way that is principally aligned to Core and Core's mission, right, of supporting new use cases and scaling the Bitcoin ecosystem. In the meantime, helping secure Bitcoin's future. So that's a little bit of a vague teaser, but there are some real world challenges that stablecoin issuers face today, primarily around the economic misalignment between how stablecoin issuers make money and what is needed to incentivize distribution channels downstream to support one stablecoin over another, and so more to come there. But this is again part of the exciting roadmap at Core, and I think what is possible when you have really deep rooted alignment between a protocol like Core and also the Bitcoin community as a whole. And I think Core has all of the right ingredients and all the sort of capabilities of other high performance chains, but with a unique alignment to Bitcoin. And I think that's a sort of duality that is really exciting and doesn't exist in any other protocol core ecosystem today. And so more to come there, but yeah, there's definitely a lot we can do to grow the ecosystem at Core.
Yeah, I mean, I love the Satoshi consensus in terms of how the relationship between the miners and Core and obviously getting them to participate in the network. I think it's brilliant. I think everyone's going to land up doing the same thing. And I think a lot of them have in terms of the competition. Obviously, it's great for Bitcoin miners. And in many ways, that does secure the future of Bitcoin miners kind of like in the years to come when, it doesn't become sustainable for Bitcoin miners to stick around solely on Bitcoin and mining Bitcoin alone. So obviously that's important. Clearly, there's something on the cook with regards to stablecoin and the core network. I understand that you couldn't let too much out the bag, but I'm still glad I got something out of you. It was not planned, by the way, to all our audience out there. It was completely off the script. I promise you that. But I think it's going to be really interesting to see how that develops and the dynamic, because that's when things get really interesting. I mean, we saw it with kind of like CVX and the ecosystem that emerged from that, and the opportunities that came out of that from a lend and borrow and stablecoin issuance and the rest of it. I think for me, the final question that I have, because we are at the top of the hour, is what's next for you and the role that you've got to play? I know that you've hinted at a lot of stuff, but like, what are you kind of expecting over the next 6 to 12 months? And we'll get you back in at some point, I hope, and we can kind of like reflect on this question.
Yeah, absolutely, and thanks for having me. It's been awesome. I can't believe it's already almost an hour of chatting here. But we're heads down right now, gearing up for the Fusion launch. Like I said, it's a lot of educating the market, educating institutional holders of Bitcoin and the various participants of the institutional ecosystem on how to participate in Core. A lot of what we discussed with institutions, like I said here, is around the safety, security of their Bitcoin asset when they do decide to participate in staking their Bitcoin with Core, the sustainability of the yield that they're able to earn based on the tokenomics of Core over the next 81 years. That's the emissions horizon, as well as the diverse ecosystem that's fast growing. And then finally, it's just being able to bring on institutional levels of scale to achieve the sort of yield targets that they're looking for. That's a lot of what I'll be focused on. And and in the future, what we're finding is that again, the way that Core is built, the symbiotic nature of Core to Bitcoin, all of the institution participants become sort of evangelists for Core, right? Because they understand that not only are they able to personally benefit their clients when they are part of the Core ecosystem, but that every additional participant, every developer that builds on Core, every Bitcoin staker that comes on Core, every Bitcoin miner that delegates their hash rate to Core is accretive to Core, right? And that is something that's really unique. So it makes my job a lot easier. It helps create leverage and friends, and helps us really enable all the amazing partners that we have in the community, as well as the institutional participants that we're excited to continue to help grow, but also folks that we've yet to speak to. There's a lot to do ahead, but we're excited to bring people along into the Core community, and we're excited to continue to build.
Yeah, I mean, I think all it takes is like, they talk about that the first million is always the hardest. And then once you've made it, it becomes a lot easier. And I think this is the game you guys are playing. And any blockchain, any business really, it's kind of like if you convince, 10, then the next 10 will be a lot easier. So I think here's to obviously wishing you guys all the best for that. I think it's obviously critical in terms of the growth of the space, the growth of our businesses, as a media company, and we want to see the best possible outcomes. So yeah, good luck. Fly the flag for us, sir. Make it happen. It's important. I think we've reached that point now where meme coins, super cycles, all fun and the rest of it. But, it's time to do some business. And the guys need to come and put their chips down. We've reached that point, and can only wish you guys the best. And it's been an absolute pleasure to have you on. Love your passion, love the focus. It's very obvious, very evident. Keep at it. Look forward to seeing the growth, the results, which I'm sure will be huge. And look forward to getting you back on. Been a pleasure. Thank you.
Thank you. Thanks for your partnership.
It's a pleasure. Thanks everyone for joining us on this episode. Please like and subscribe. We do appreciate it. And we'll see you guys next time. Take it easy.
Quick one, nothing here is financial advice. It's for entertainment and educational purposes only. Always do your own research or speak to a financial advisor before making any investment decisions. Like and subscribe.